So with those two syndications, I was on the webinars, got some emails and joined a lot of other webinars just to learn about it more. Man, this is exactly what I want to do. I want to go on the active side because I love the syndication space in general, because I had such a huge syndication, as corny as it sounds, had such a huge impact on me and my life, because I felt like that was exactly what I wanted for my life, for my legacy, to help others.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder and CEO of Zana Investments, Tim Little. And on today's show, we have with us Charlie Hardage. Charlie is managing principal of H&KInvestmentGroup, a real estate investment firm that believes financial freedom should be attainable for everyone. Charlie is an Army vet with multiple combat tours like myself, and worked in the corporate world for over 12 years in IT sales with household names like Google, Dell, and AWS. Charlie, welcome to the show.
And thank you so much for having me. I'm super excited to be here.
Yeah, and I am excited to have you. It seems like we have a lot of things in common, so I'm glad we got this opportunity. So I gave everyone a high-level overview of your background, but on this show, we really like to get into the details of how you got started on your journey. So please take us back to the beginning and tell us how you got to where you are today.
Yeah, man, absolutely. It's interesting because I think, and I don't know if people can see it, but you have a book behind you, Rich Dad, Poor Dad. I grew up with the proverbial poor dad, right? I grew up middle-class mindset, all about school, education, jobs, working for someone, IRA, all that stuff. Nothing wrong with that. But when I was 5 or 6, I had a good friend, and still to this day, known him almost my entire life. And probably about 10 or 11 years old, it hit me, Tim. I was like, man, his dad's always around. What does he do? And my dad worked a lot and wasn't there nearly as much as my friend's dad, where he would be able to pick us up from school and take us to sporting events or putt, arcade, movies, whatever it was. Just like, what does he do? And so fast forward a few years later, I actually started working with him during a summer job, and he had his own businesses left and right. And he didn't have a college education, but very smart guy, but no college education. And so that kind of lit a fire under me when I was like 10, 11, of there's something else out there. Had no idea what it was, but I knew there was something else out there. Fast forward several years, I went to college, and at the end of college, I worked for household names like Dell, and selling computers and printers, all that good stuff. And I worked there for about 2 years, Tim. I joined the military at the nice old age of 25. And I was extremely old for the military for joining at that age. But yeah, so then after the military, I wanted to make that a career, but got injured in the military. And so I was medically retired. So I went back to the IT world. There was still always that drive within me of, there's got to be something different than that path that I've been taught, and the path that I've been taking. And when I was in the military and I was injured, I realized, since I cannot make the military a career, I've got to figure out what else to do. And on my second deployment, I read Rich Dad, Poor Dad, totally opened my eyes, changed my mindset, or started changing my mindset, and but super interested in real estate. Didn't know what niche I wanted to do. I was introduced to multifamily probably 10 years ago or so now, when I was in the military, but didn't take action, didn't really take that leap. And fast forward, I worked in the corporate world. Wasn't a passion of mine. Passion was always having my own business and providing for myself and for my family, as opposed to relying on a job and someone else to provide for me. And about 4 years ago, jumped into multifamily as a passive investor. Loved it so much, I started learning a lot more, and jumped into the active side about 2 or 3 years ago. That's a very quick overview of my 39 years. But yeah, love real estate. Absolutely love it.
Yeah, and so I'm just going to hit on some of those things that you talked about in there, because I think it's going to resonate with a lot of the people that are listening, right? For anyone who has read Rich Dad, Poor Dad, which is probably 99% of anyone who's listening to any sort of podcast like this, They understand that there's the different types of dads, right? The rich dad who finds a way to be more entrepreneurial, invest in assets instead of liabilities. And the, quote unquote poor dad is the one who takes the well-worn path, which is not necessarily a bad thing, like you said, but it's certainly limited. And I think that's where people like you and I found ourselves. My dad was more I guess you could say, blue collar poor dad. I hate to use that term, but working class dad, right? And people who've heard my story before know this. He was a TV repairman, which was a job that literally disappeared because of changing technology.
Yeah.
And so at that point, what he did was more the entrepreneurial side of things. He found a way to make it happen. He wasn't going to rest on his laurels. But I think what's interesting, he was around because it was mostly 9 to 5 type stuff. But at the same time, he had a different mindset. It was that he didn't have an abundance mindset. So it was always about, oh, we can't spend that money. He was very thrifty, shall we
Yeah.
say, right? So we didn't go out to restaurants. We didn't go on big vacations. Anything we did, it was probably free or heavily discounted. And so there's a lot of valuable lessons I took from that. But at the same time, that becomes a limiting factor too, because people who are in that mindset are not likely to invest,
Right.
especially not invest in anything outside of what society has told them is the least risky path, which you talked about the 401k and stuff like that. So I think it's interesting that you came from a similar background, but we've both broken away from that. But I would argue probably taken some lessons from that side as well. Would you say that's true?
Oh, absolutely. And one of the things I read last year, I forget who the author was, but they talked about everyone thinks that going out on your own and starting your own business, or even if it's a side business to start, if you're working full time, is so risky. Sure, there's risks with that, but there's risks with everything. And staying in a job, what happens if you get laid off, which happened to my dad many times. I know right now in 2023, we're going through definitely a downturn in the market. And there's a lot of people that have lost jobs, especially in the IT sector, which is where I came from. I know a ton of people that have been laid off even twice over the last 6 months. And it's a lot of work to start your own business. But I do think the middle class mindset has helped me in that sense of you got to work hard. You can't just be lazy and expect a business to work. So I do think working hard has really helped me in the real estate side of things for sure, because, and Tim, you're probably in the same boat. We don't have these massive budgets to hire all these people to build a website, do marketing, social media, all that. So it's a lot of thrifty from that side. And you got to figure out how to do things first, and then you can start outsourcing it and things like that. But I've definitely taken so many learnings and teachings from the middle class mindset and been able to tweak that and go from a scarcity mindset to an abundance mindset over the last few years. And I think taking that big risk for me was extremely hard at first, but now I take risks, but they're calculated risk now, and I'm not afraid to take those.
Yeah, and that's a really important point about taking those calculated risks when it comes to taking action. Because we always
Right.
talk about all these people who listen to all the podcasts and they read all the books and then they do nothing.
That was
They go
me.
to the,
That was me.
and I feel like all of us have that for some amount of time. It's just a matter of whether some of us stay in that place longer or not as long before we're like, all right, screw it. Like, I got to take action. And as long as, like you said, it's calculated risk and you've mitigated those risks as best you can, and there's a reward on the other side, then you got to pull the trigger, right? At some
Yeah,
point.
totally agree.
Yeah, and so I guess you were talking about the work ethic that you took away from your dad, and I guess mine would be one, the work ethic, but also the living below your means, because as a general point of people being in a position where they can invest, what allowed me to invest was the fact that I lived below my means long enough that I was able to save up money to invest, and I think that's where a lot of people go wrong because I see so many peers who lives paycheck to paycheck. And that could be someone who makes 30,000 a year, or that could be someone who makes 200,000 a year. There is no income cap to living paycheck to paycheck, which is scary that
Yeah.
people that earn that high of an income still are. They just have this YOLO mentality. You only got one life, you got to live it. But at the same time, I think you can make some sacrifices early on so that you're able to do the things that you want to do later. Not necessarily 65, 70. I'm not talking about that when you can't even enjoy it, which is the other side of that coin, right? Where people don't spend any money, they put it all in their 401k or something. They're like, man, when I'm 70, I'll be golden. Yeah, you'll be golden, but you'll probably also be broken and won't be able to do all that travel and see all those things that you wanted to do. So I think that being able to have the discipline to live below your means so that you can save money in order to invest is another important point.
Yeah, I totally agree. And I think if you go the W-2 route, again, there's nothing wrong with that. But the way I saw it, Tim, was I don't want to work until I'm 70, have a modest or a nice nest egg. And if you're listening, I did some air quotes there, but have a modest nest egg, but not be in great shape and health. And in the military, I had an injury that forced me to retire. And so my timeline's not 70 years old. My timeline's probably 50 or 60, which is scary, but where I want to be able to get out and travel. I want to be able to do things with my daughter, my young daughter now, and my wife, and we have been able to travel, right? And we do it economically. We don't YOLO out there, but it's nice because we are invested into over 1,000 apartment units, some nice cash flow going on. And some people, I remember when I was first started working in the workforce and people were just going out, spending tons of money immediately. I know how much you make. I don't know how you're affording this. And so I think there is a nice common ground there. But one of the most important things I think for me and for a lot of people is to get that time freedom and that financial freedom. And there is a way when you invest in assets, you buy assets that produce income and you can use that income to reinvest or to enjoy travel. But you are investing first, right? You're not traveling first. And I think that's the big and key takeaway that I got from Rich Dad Poor Dad is to be able to, instead of buy a vehicle or travel with that money that you make, buy something that produces that income, right? And then you're always getting that income as opposed, and you're able to spend it on travel or you're able to reinvest. And I would love to be able to, in 10, 15 years, when my daughter's of age, just go around the world, right? Because I work for myself. I'm not in the corporate world anymore. Our investments are coming in. So we'd be able to afford that. And we wouldn't have to wait till we're 70 because we change our mindset to invest first and then have fun.
Yeah, absolutely. I couldn't agree more. And you talked about coming out of the military. And the military is a unique case when it comes to we talk about like that middle class path, right? Go in, working for 20, 30 years for the man, and then getting out. The military is a little unique in that it's one of those few places where you still get that pension. And
Right.
that pension can be very attractive because you could come out of the military after 20 years at age 42 and have that 50% of your base income for the rest of your life and still very well move on to a second career where you're making a really good amount of money on top of that pension that you have. I know there's some military listeners and they're unique in that respect. Now, I think some people get caught in the trap of staying in 20 for the sake of the pension. And
Yeah.
there's still some opportunity costs there as well, just like there
Yeah.
would with any other job. But I mean, if you love it, then by all means do it. And I think what's important is it doesn't prevent you from doing the kind of stuff that we're talking about, which is investing in real estate, whether that's single family, passively investing in commercial multifamily. You can do all of those things while you're still in the military. And this just isn't just my imagination. I've seen lots of people who have done it,
Yeah.
especially on the passive side. It's that much easier because you don't have to worry about being a landlord, keeping up with it, and you're still getting all of the same tax benefits and such.
Yeah.
And it's one of those things that I wish I knew, but at the same time, there's a lot of financial stuff that I didn't know that I had to, I wouldn't say learn the hard way, but learn the hard way
Yeah.
and learn it late. And so now I feel maybe like you, I don't know, that I'm trying to play catch up with all this stuff, but it's still better to start late than never.
Yeah. And it's interesting because when I was in the military, and this is ten years and more ago, you deploy, you come back with a ton of money because where we were, you couldn't really spend it. It's tax free. You get a bunch of extra perks depending on your MOS over there. And I had friends that bought $50,000 vehicles, which nowadays probably $80,000 vehicles. And maybe they paid cash or maybe they put a big down payment. It's like, had you invested in something and got a beater car or something that worked because you're going to deploy pretty soon again anyway, you'd be able to have that money work for you. That way, when you get out from your second deployment or third deployment, whatever your next one, you'd have some more cash. You can reinvest that. And if you just get that delayed gratification instead of an instant gratification, I think that would speed up your timeline so much. I posted on LinkedIn a couple of months ago about if you invested $50,000 into a syndicate. A lot of syndications, they do vary. So this is just a general term, but 5 years, if you double your money every 5 years and you do that for about 30 years, you take $50,000 one time. And this is not reinvesting or not investing any more money, but you take that $50,000 and you reinvest and you do that for 30 years, you're walking away with $6.5 million, I think is what it was. And so if you're in the military, put your money to work. Don't go out there and just spend it. I know a lot of, especially enlisted, you have to get a team leader or squad leader to sign off on buying a car. But what's interesting is those team leaders and squad leaders are the ones that were buying the $50,000 vehicles, and so it's just, you're learning from people that really don't know much better than you do. And that's not a shot at those people whatsoever. It's just how it works. Most people are guaranteed a paycheck when you're 18 years old and constantly having money come in. So you spend a little bit more. But if you just invest even one time, that would have such a huge impact on your retirement.
Yeah, and I saw it just like you did, and I was there, but it just goes to show the tremendous difference that time and education can make in priorities.
Yeah.
20-year-old me thought that the best use of my money was in a 12-inch JL subwoofer in the back of my car because, everybody needed to hear my music as much as I did, and that was really
Obviously.
important.
Yeah.
But then in 2018, when I was going on my most recent deployment, it was okay. Let me make sure that I have enough set aside to put into the savings deposit program where I'll get a 10% guaranteed return over the course of that 12 months. And I passively invested in a syndication right before I left. That was my first passive investment. And so I was like piling on all of these things based on what I had learned over those years. So that's why I'm so passionate because I'm still in talking to my soldiers and officers about financial literacy and well-being because so many of them are in a bad place. And like you said,
Yeah.
they just don't have people to talk to them about it. So I'll be that old guy who already made the mistakes and tell them how they can make it better because they still have time. All right. Hey, this is good, but we need to move on to some other questions. And I want to get into what made you decide to leave the corporate world? At what point were you like, no, was there any breaking point or was it just a transition?
When I was 10, 11, and had my buddy's dad, the rich dad that had his own business. And to me, it wasn't necessarily about the money. It was more about the time. And that lit a fire under me that burned for far too long. And when I read Rich Dad Poor Dad on my second deployment, I wanted, I knew I needed to do something. I just didn't know what that was. And I was still learning. And as I was getting or out processed from the military, it takes a long time to do that. It took me several months, probably 9 months or so. I was reading as much as I could about real estate, different types of investing. So I knew that's what I wanted to do. I just didn't know. Number one, I didn't know what I wanted to do because there's so many niches in real estate and different ways to invest. I knew I wanted something that I could control. And working for a W-2, you can control where you work, and that's about it, right? And so I think really when I was medically retired, again, military was a career move for me. My plan was to stay in at least 20 years. My second deployment, I was actually looking at going green to gold. I was enlisted. I had a degree, but I was looking to get my master's and become an officer. And I was shot. And so I was medically retired. So I had to do something totally different. Uh, I was researching anything I could, and I just didn't know what that was. So when I got out, I did what I knew best, which was IT sales. So I did that. That wasn't a passion of mine. I didn't hate it, but it wasn't a passion, and real estate was a passion. I just didn't know what niche. Fast forward, learned a bunch of different types of real estate and really got sold and hooked on the passive side of syndications. And I was like, man, okay. When I first invested, I'm like, I got 5 years before I leave my job. It wasn't so much about I wanted to leave the corporate world and there was all these red flags. There was some, but the big thing was I knew I wanted to leave the corporate world and do real estate. I just didn't know what type of real estate for the longest time. And then in the corporate world, a couple red flags came up, and I was like, you know what? I got to speed my timeline up. So I went from 5 years to 3 years. And ultimately, that timeline went all the way from 5 years to about a year and a half before I left, just because I was fed up with the corporate world and not really having that control. I'm not at all a control freak, but doing things a certain way, I'm like, guys, there's such a better way to do this. Why don't we do it this way? And when in syndications and real estate, you have so much more control on the outcome than you do in the corporate world and in a business. So it wasn't necessarily one or two instances. It was just a combination of I knew I wanted something else. I knew it was real estate. I didn't know what it was. And as I started getting into multifamily, I'm like, okay, I really like this. And then a couple red flags happen. And then I'm like, yeah, I'm all in now. Combination of both. I finally figured out what I wanted to do in real estate, and corporate world was not for me.
Yeah. And so it sounded like those two things were happening in tandem.
Yeah.
And so I think that's a good segue to go into your real estate trajectory and what that looked like. Cause I know a lot of people are listening. Yeah, I haven't invested in or bought my first property. Like, where do I even start? And what does that growth look like? And you've had a pretty fast trajectory since you started in 2017. Tell us what that growth looked like and the different steps in there from first deal, second deal, and just how you managed to scale in the way you have.
Yeah. When I first heard about multifamily syndication 8, 9, 10 years ago, I didn't understand it. Again, my mindset wasn't there. And I was at my very beginning real estate journey. And so I heard about it when I was in the military, didn't have any money to invest and didn't have the time to just travel and things like that. I think when I finally got my head wrapped around the real estate side of things, I did what almost everyone does: single family. We had a house and we had a house that we owned. We ended up moving, bought a new house, and we rented the previous house out. Did that for a little over a year. Great tenants, but it was a lot of work. I did it myself. It wasn't passive. I worked a ton. I worked 40 hours, but I had about a 2 hour commute every day round trip, and had how old was she? Probably 3-year-old daughter, 4-year-old daughter at the time. And it was just not really what I wanted to do in terms of be a landlord. When I got reintroduced to multifamily syndication 2.0, maybe, I was like, wait, okay, so this is passive. Like, what? Okay, it's passive. I get that. But what do I need to do? Because I don't have time to go travel to the property. No, it's passive. Like, no, I get that. But what do I have to do? And they're like, no, nothing. You invest, we do the work, and you get a return. I was like, oh my gosh, that's amazing. So we right before that ended up buying another single family property. Man, it was great, but it's so much work at first. It was so much work to find the property. It's near a military base, doing very well, very nice cash flow. The problem is it's not passive, right? And in tandem was learning a lot more about the syndication space. I'm like, you know what, screw it. I'm not buying another single family home. That was too much work for a few $100 a month. And the cash on cash is nice, but it's only a few $100 a month. And so
Mhm.
we ended up getting into a passive syndication. And within 3 weeks later, I jumped into another one because I'm like, this is awesome. This is so amazing. And so with those two syndications, I was on the webinars, got some emails and joined a lot of other webinars just to learn about it more. Man, this is exactly what I want to do. I want to go on the active side because I love the syndication space in general because I had such a huge syndication, as corny as it sounds, had such a huge impact on me and my life because I felt like that was exactly what I wanted for my life, for my legacy to help others because I was just impacted so much that I joined a bunch of other webinars, learned as much as I could, started looking for deals where I was an active investor. And about 8 months after I got into my first two deals as an LP, I was in two deals as a GP. And I was like, man, this is amazing because I had friends that invested in it that, again, had never really heard of it before, syndication. And they're like, this, they had the same kind of conversation and same thought process that I did. They're like, okay, but what do I have to do? Because I don't know too much about real estate, but I want to invest. I was like, no, you don't have to do anything, right? It's passive. And so that word passive, I think we say it a lot, Tim, because we get it now. But years ago, I was like, I get passive, but I didn't really get passive. It just had such a huge impact on me that I just went all in as quickly as I could. We had a lot of equity in our home. We took out a HELOC, invested more from the HELOC, which paying small percent of interest, getting a huge return back. So some nice little arbitrage there. And that for us was just like, man, now I truly feel and again, it's real estate. What we do is not get rich quick. But if you keep at it, it will happen over time. And my goals aren't 6 month goals, 6 year goals. They're 30, 40, 50 year goals, right? I don't want to just travel the world. I want to travel the world, but I also want to build a business that I can pass on to my daughter and help the community and things like that. I'm the type of person that it takes me a while to get started because I truly feel like I have to know all the ins and outs. But when I feel like I know the ins and outs and I feel like it's a good investment, I go after it nonstop.
Yeah, and you brought up a lot of great points in there. I think the first one is you started out so many of us do, which is that accidental landlord, right? Oh, my former residence, and I'm going to rent it out now. And there's no better place to start because there's you're already there, right? You already have this extra house. You might as well
Yeah.
go ahead and rent it out. And it's the first exposure that a lot of us get to the whole landlording aspect of it, and all the good and bad, certainly that come along with it. And then the point that you said about passive and what do I have to do? And I think there's two sides to that coin, right? There's the you don't have to do anything. And technically you don't. But what I always caution passive investors is what you do have to do is do a little bit of work up front
Yep.
in order to vet both the sponsor and the deal. That's just prudent, right? That's your due diligence because you're about to put a significant amount of money into this person and this deal. So it's certainly my recommendation that you do a little background check, run the numbers, have a cursory understanding of the business and the business plan and what it looks like. I certainly don't expect people to fly out to the properties and walk it and see units and talk to the property manager. That's what we're there for. We're there to do that work and to sit in on all the asset management meetings, property management meetings, and make sure that business plan gets instituted the way it's supposed to.
Yep.
But they still should, I would argue, put in some work up front. And some of them, like some passive investors, once they get comfortable and they have a good understanding of how these deals work, they can do that very quickly and just look at it and know if it fits their criteria for what they want to invest in because they're thinking about their risk tolerance, how long they want to be in the deal and not have the liquidity, which is
Right.
legitimate. And so that's where different deals make sense for different people. And it's not that one is a bad deal necessarily. It just might not be the right deal for you. So that's why you have to look at it to just make sure that it fits your needs. Talking about your LP deals and how you went right from one to the other. That's pretty brave. Like I needed a little time for my first passive deal to sink in. And like I said, I had the time because I was on a deployment. I wasn't doing anything else other than working. But and for me, it was like, okay, let me see that first distribution because I was still needing to be convinced that this was legitimate, that this was a real thing. Because a lot of people that it sounds like you talk to, there's that element of sounds too good to be true. Like I can still not do all the on the ground work, but still get the benefits of investing in real estate, be it the tax advantages, etc. And so once I got that first distribution check, I was like, okay, all right, this is a real thing. I believe it now. And from there, like you, I was off to the races. So you got into two deals as a GP. I think you said what, 8 months after you had
Yeah.
done those LP deals. Please talk to me about how you got into your first deal as a GP, because I think that is the biggest hurdle that a lot of folks who aspire to be active investors, to be GPs, they just can't figure out that step, how to get into that first deal as a GP.
Yeah. I would say that after my first two LP deals, I was totally hooked. I started going to webinars, like I said before. I knew I wasn't going to invest in those, but I wanted to see what else they offered because the two LP deals were with the same core team. And so I wanted to see like how else are people partners, what's their business plan? And I know business plans from deal to deal, even with the exact same sponsor teams, can be totally different. But I wanted to see like what other ideas were out there. So I just started learning a lot from other investors, talking to people. And I started underwriting a lot. I'm an underwriter, help come up with the business plan. And so I was on a broker's list and it was a deal close to me in Nashville that came up, started underwriting it. I'm like, okay, this looks pretty good. And I went to I went to a husband and wife team that's also local. And they're like, yeah, this looks good. Let's talk to another team that was local to Nashville. So we all teamed up, got on a bunch of calls, underwrote it together and just went over everything. I had no experience besides the passive investments at that time. And but the experienced partners, they've had several deals, right? So it wasn't just me on the team. And that's what I love about syndication. It's not one person, it's multiple people. So we toured the property. The partner that's in this syndication with us as a general partner, he is also a broker, apartment broker. So he knows a lot of questions to ask and he knows the brokers and knows lenders and insurance and property management. From that experience, he's really helped. Now I know a lot more because you can go and find a property manager online easy, but that doesn't mean they manage very similar properties to the one that you're looking at buying. Maybe they're only single family or they do multifamily, but only up to 40 units. Maybe they know 100 unit plus, but they're only in the south side of where you live and don't know too much about the north side. So fortunately, he took the lead and his wife took the lead in that to help guide us. And we've owned that one for almost 2 years now. And I've learned a ton. And on the asset management calls, I'm also able to help with ideas. I still definitely take a back seat to those calls, but I'm able to provide insight and experience from some of the deals I'm on. So I think really for me, it was just finding someone with experience and one of the biggest reasons I never took action, Tim, was because that was such a huge risk. But if I invest with someone who has experience, like I did with those LPs, the LP deals, it's not a risk, it's a calculated risk. And I think that's a huge difference because you are relying on them for a lot for the experience. And that's what I did. So my first deal as a general partner was with many people that had already had experience. So that was the first deal. What I love about that deal, Tim, was I went from the very beginning. I got the email from the broker. I underwrote it. at the same time, this couple who I didn't know at the time, they had underwritten it as well. And we all formed a group and were able to tweak the underwriting, tour the property, ask questions, and talk to the lenders, talk to insurance, all that together. So I felt a lot more um, at ease because I wasn't the only new person, or I wasn't the only one who was also a new person going after 105 units by myself.
Yeah, and I'm gonna dig a little further on this one. So because I think again, when people are looking at this hurdle of getting the first deal, they're like, I don't know what I bring to the table because everyone just says you got to add value. If you add value to a team, then they're going to take you in, and that's such nebulous advice. But it sounds like on this deal, on that first deal, you were underwriting it. So was that the prime value that you were adding to it? Were you also bringing capital to the table, or what was your role on that team as you see it, and why they were willing to bring you in as a GP, being one of the less experienced folks?
Yeah, that's a great question. And I think maybe I don't know the word here, but maybe I'm underselling myself. But I truly think they didn't need us to close the deal because they had underwritten it. They had the contacts. They brought more capital than I did. They had the experience. So for me, I think it was the fact that I went to this group or to this other couple and they provided value from she's a director of marketing. I have a IT background. So we are able to help with some of the small things that those experienced partners probably don't have that experience and expertise in. And so we were able to add value from that standpoint. We have internet at that property, and I took the lead on finding internet providers. The director or the marketing person, she's been doing this for 20 years. So she's been able to help with a ton of like Google and Facebook tips that even the property management company didn't necessarily know about. But would that sell us on getting in the deal? Probably not, to be honest. And we were brought in, I think, because we all just started touring the property together and maybe they were throwing us a bone to get in. But now that we've proven ourselves and we do actually add value, then they probably wouldn't say, okay, well, let's kick them out. I know that can't happen, but we'll kick them out now because they're not doing anything. We are actually helping, but at first it was pretty minimal, to be honest.
Yeah.
I was, and there's a second deal that my second deal as a GP that I added very little value to that one, but it was out of state and my sister and brother-in-law used to live in that city. And so I actually knew the city way better than any of the super experienced sponsors
Mm.
just because I knew exactly where this property was. I knew where the growth patterns were because I had been there multiple times a year for several years before we got into that deal. So from that perspective, helped them with a little bit of capital, but it was also just, this is where the growth is. And now, did they need me on that deal? Probably not. But again, I was able to provide a little bit of value. And just to be transparent, that my GP share on that is very minimal. It's not, people think being a GP, you're going to make bank and you're going to be able to retire or whatever. It's not, definitely not the case, but I did add value to that. Even if it's a little bit of value, there's still value to be had.
Yeah, and there's a couple of points I want to quickly hit on because we'll have to transition here and chirp around. But I think there's some important points lying underneath what you were talking about. And the first of those is even if you're not doing the largest chunk of the work, or you said they may not have even needed you. Now you're probably still helpful and you still contributed, but did they necessarily need you for the deal? And the answer is no, that's still okay because I think it goes to show that if you're networking and getting around the right people and showing that you can bring value, then people are willing to give you a chance. And once they give you a chance, then you become a known quantity. And then then you start to get the snowball effect. I feel the same way about my first two deals that it was, I don't want to say luck because again, I created the environment, the situation where I was around these people, made it sound like I knew what I was talking about and was willing to work, even if they didn't technically need me to get the deal done. And I didn't even raise capital on my first two deals, but the opportunity for me was to be there to learn, right? You talked about how you may not be the one who's talking in some of those meetings, the asset management meetings and stuff like that. But if you're still able to listen to those recordings or be a fly on the wall, you're absorbing so much knowledge
Yep.
through the interaction, understanding the problems that come up, how those problems are dealt with, etc. That is invaluable, which goes to the final lesson that you brought up at the end, which is, hey, it's a small slice of the pie. But you know what? And this is something I will stress to every person who is an aspiring active investor. Do not worry about the size of your split on that first deal. You need to just be happy that you got on that first deal, because that in and of itself has inherent value. And you need
Yes.
to understand and appreciate the value of being able to say, I was a general partner on a 100+ unit deal, and that's it, right? You have instant credibility at that point. People know that you have some level of experience and you have the opportunity to learn the craft like on the job, as it were. So I think those are really important points that we're able to tease out from your experience.
Yeah.
Uh,
I go ahead.
but no, if you have anything else to add real quick.
It'll be long, so we could probably just move on. I know we have a few minutes.
All right. Then let's move on to the turbo round. I'm going to ask you three questions that I ask every guest that I have on the show. And I just ask that you give an honest and quick answer. First question: what is one red flag every investor should look out for?
From a passive investor standpoint, even a co-GP standpoint, I would say not enough experience or inexperienced active GPs.
Right. And that doesn't necessarily need to be that individual that they're investing with, right? Because sometimes the team can make up for the lack of experience that maybe the individual you're talking to has. Would you agree with that?
100%. Like on my first deal, why would people invest with me? They wouldn't unless we were with experienced GP. And the GP team was experienced, but I would just say if the GP team isn't experienced or maybe not experienced in that market and don't have any contacts or property management companies, that's a red flag.
Yeah, absolutely. New asset type or region or something like that. And
Yeah.
if they didn't bring someone into the group, into that GP team who does have the experience in that asset or region.
Yeah.
Agree 100%. All right. Next question. What is a myth about this business that you would like to set straight?
It is not at all a get rich quick business, but and this is to set the myth straight, if you do invest and reinvest for the long term, you will get rich doing it.
Yeah. And I think that's a super important point, both for passive investors and for active investors, those GPs. Like I know some of the gurus talk about, okay, within 2 years, whatever, you'll be able to quit your 6-figure job. And, okay, calm down. Like most of the time, it is not going to work out that way. And the reason for that is simple and obvious, right? These deals have 3, 5, 7-year time horizons in
Yep.
most cases. So we get like a little tiny chunk at the beginning for that acquisition fee, but really we don't get our payoff unless we've implemented that business plan and gotten our investors the returns that they expect. And then when we exit year 5, 7, whatever it is, that's when you get that big chunk. So that's why you got to keep building that pipeline. And for the passive investors, same deal. It's a patient game, right? But that should be true with any type of investment like this, right? People don't invest in the stock market and expect to get rich overnight. Now, we could talk, Bitcoin and other things. That might be a little different, but that has painful memories for me, so I don't want to go back. All right. Final question. What does success look like to you?
In one word, I would say freedom. And that's time and financial freedom, where I can do what I want when I want. Maybe that's travel the world for 6 months. Maybe that's go on a cruise for a month, whatever that is. I love to travel. So it's just freedom.
Yeah, absolutely. That's something we hear so often on the show. Freedom of time, freedom of money, of course, being able to buy the things that you want, but that freedom of time is so important, especially people who have kids, family, because that time with our kids is so limited. I talk about this a lot where we have up until, say, age 18 before they move out of the house, but we probably really only have until about 13 before we stop being cool enough to hang out with. And so you just have to factor that kind of stuff in. Hopefully that's not the case, but that time is very short that we have with them. So the more we can maximize it, I think the better.
Totally agree.
All right, Charlie. Hey, this has been awesome. Please tell our guests how they can get a hold of you and if you have anything else that you would like to share with them.
Yeah. Best way to get a hold of me is through our website, hkiglc.com. I'm on Facebook, LinkedIn as well. I do have a podcast called Passive Investors Playbook. It's a real estate show that kind of breaks down how to get started in real estate. I interview successful people that are in real estate that came from a different path. So yeah, you can find that on all the major platforms.
Awesome. And we'll definitely have all that in the show notes. But listeners, if you dig podcasts, which I expect you do if you're listening to this, check out Charlie's show. Make sure you leave a rating and review for both of us, please. It helps a ton in order to get this out to more people. I appreciate you coming on, Charlie, and I really look forward to continuing to see you do big things on your journey to multifamily millions.
Yeah, Tim, thank you so much for having me. It's been a true pleasure.
Yep. Have a great weekend.